Yes, thank you very much. Brilliant, brilliant. Glad to hear it. Thank you, thank you. Awesome. All right. So let's get started then. Thanks a lot for your time, guys. I really appreciate it. And some familiar people and a couple of new people, which is great. So let's get rolling. So you're here for the naked trading session, and my name is Walter, and it's great to have you here. I know a couple of new people are here, a couple of regulars, which is great as well. So a lot of familiar names and a couple of new ones. So just curious, where are you guys logging in from? I'm just curious to see which cities you're from. I know most of you are watching the recording, which is cool, which is cool. I'm just curious. The ones that are live here, I think, are most of them are going to be in Europe. Is that right? Where are you guys coming from? Just curious. I'm going to take a sip of my tea here while I wait for the replies to come through. London, awesome. And South Africa, excellent. Toronto, wow, it's pretty early in the morning there. I'd say, what is that? Like 6 a.m. in the morning there, I think. It's not, I guess it's not that early, but still. Yeah, 6 a.m. That's what I thought. Yeah, cool. Hello, Adam. Glad that you were able to make it. Thanks a lot for making it. Yeah, 6 a.m. in Toronto. Okay, cool. So we got a good spread now. Madrid as well. Sweet. Beautiful city. Cool. Okay, great. Well, I was just curious. Now, today it's not about the trading system. Now, I know most of you know my name is Walter Peters. I wrote the book Naked Forex. I like to trade without indicators. And I think a lot of people can trade without indicators, and indicators in many ways can hold you back. There's nothing really wrong with them, and I suppose you could trade with them if you wanted to, but it makes it easier for you to cycle through different systems and never really settle on anything if you concentrate on the indicator rather than the market movements. So what we're going to talk about today using market movements is how do you build your system so that you don't throw it away in the trash and light it on fire and stomp on it and say, I'm never going to use that trading system again. In other words, how do you become one of those traders who's been trading the same system for years and years and years because you're so comfortable in it, with it, you're very confident in it, and you know that it's going to extract profits from the market for you repeatedly. How do you do that? How do you become one of those traders? It's not really the system that is key here. It's the other side of the coin, which is you. So what I'm going to do is I'm going to send you through a couple of, and the more you work on this, the more you take this seriously, the more you will get out of it. So some of you are probably going to watch this video and go, I don't really need to do that exercise or whatever. I would challenge you to do it. Try it. Write this down on a piece of paper. If you're watching this recording, obviously if you're here live, you can do it as well. But if you're watching this recording, take the time to grab a piece of paper, grab a scroll or an animal skin or a sticky note or the back of a book, something that you can scribble on and go along with this, because I think you'll find that this will identify for you your trading beliefs. And then based on those trading beliefs, we're going to set you up with a system that you will trade long term. In other words, something that you're going to be successful with and something that you're probably going to want to keep doing instead of, switching and going from this to that and the other. So does that sound good to everyone? How do you like that? Does that sound like a good idea? Sweet. The yeses are coming through. Brilliant. Thank you very much. And I know those of you that are watching the recording, some of you are thinking, yeah, that sounds pretty good to me too. So that's great. Yes, I ordered the book Naked Forex, but have not received it yet. Okay, cool, Fred. That's great. When you get the book, you'll also get access to a members area with additional videos so you can see, what's talked about in the book. You can see it kind of in real time on the charts too. So that's excellent. I mean, the book's got tons of charts. That was one of my requirements. The publisher wanted to have so many words, and I said I wanted to have so many charts. Because I wanted to make it very clear what the setups were. Because sometimes I think in trading books they don't have enough charts. So lots of charts. Cool. All right, sounds good. All right, let's roll. Okay, let's get going. All right, so this is what we're going to do. Number one, what I want to highlight here is this candle right here is what we would call a kangaroo tail. Okay, so this is on the far right hand side of the chart. Kangaroo tail was, this was something that was discovered or written about by Dr. Alexander Elder, who wrote the book Come Into My Trading Room. It's the first time I saw this, and I thought, wow, that's fascinating, this kangaroo tail idea. And he actually spends about a paragraph talking about it and doesn't really go into it more than that, which is funny. But this idea of trading a kangaroo tail was something that kind of resonated with me, and so I've kind of have my own rules for what makes for a good kangaroo tail. Now, some people have said that this sounds like a Pinocchio bar, and I suppose that not every Pinocchio bar or pin bar is a kangaroo tail, but every kangaroo tail is a Pinocchio bar. So it's a special case of a Pinocchio bar, sort of like my big shadow, which is a special type of an engulfing candle. It's not the same engulfing candle that everyone trades, but at the same time, it's an engulfing candle. I mean, so it's a special type of one. It has to do certain things to be interesting to me. So let's talk about this. This is the Euro 4-hour chart that we're looking at here. And the market throws up this little kangaroo tail, which is a bullish signal. Now, what you'll notice is that I typically will put my stop loss when you get the book, Fred, you'll know that I put my stop loss on the other side of the tail, which in this case is going to be about 50 pips away. So with this trade, we've got 50 pips of risk. If we place our order just above the high of this kangaroo tail, and we place our stop loss right on the tail, then we have about 50 pips of risk here. Now, I'm not saying that this is a brilliant setup, that this is the perfect type of kangaroo tail or anything like that. It's really I'm just using it for illustration purposes for a reason that will become very clear to you in a moment. So what we're trying to do here is define the risk, which is 50 pips of risk, okay? And if you're talking in terms of R, which was a term that I first heard written about by Van Tharp in Van Tharp's book, Trade Your Way to Financial Freedom. So R would be how much you're risking versus how much you're looking to gain. So it's kind of like your measure of reward to risk. So if we were looking at this yellow line here that I've highlighted on this chart where we've seen the market bounce here, find support, double bottom support, and then it found brief support here for about 5 days before it finally fell through. Actually, it fell through on the 5th day, but this would be a level of support and resistance. Okay, so if I were to say, okay, I'm going to buy at the top of this kangaroo tail, just a little bit higher than kangaroo tail, and I'm going to take profit up here where this zone is, where this yellow zone is, that would be 50 pips of reward. So it's 50 pips from the top of the kangaroo tail to my ultimate profit target, and there's 50 pips of risk. So my R on this trade would be 1. So if I were to make one positive R, it's because it hit my target. If it were to stop me out and hit my stop loss at the other side of the kangaroo tail, that would be a negative 1.0 R. Okay? Everyone's clear on that, right? Pretty much makes sense. Is there anything that's fuzzy on that, or is that pretty clear? Yeah, okay, cool. Cool. Great. Thank you. The people are funneling through. Excellent. So now this is going to get to the point here where I want to show you something, and I want you to decide, okay? We're almost there. I promise we're almost there. Okay, so what I'm going to do is I'm just hitting the F12 key, and you can see that the market would have pushed through an order that was placed at the top of this kangaroo tail. Now, this isn't really, this webinar is not about showing you the kangaroo tail trading system. Really what I'm trying to do here is show you something else. And it's going to become really clear in just a moment. Okay, boom. So we've hit our target. So it took a few candles to get there. It looks like it took about 8 candles, 9 candles to actually get to our target, but it's there. We've hit 1.0 R. There was a bit of a drawdown, but we did hit 1 R. So now we're cashed out and we're happy, right? Is everyone thinking right now, yeah, this is a pretty good result? You think this is okay? What are you thinking? When you see this happen, what comes to mind? Yeah, excellent, or something else, or what are you thinking? Just curious. Type in the chat box. There's no right answers. I'm just curious what your thoughts are now. I'm going to take another sip of my tea. It's okay based on the setup. Cool. Okay, great. One R is too small. Yep, I can see where some people are going to say that. And usually those are people who are okay with a lower win rate. Usually the people that are okay with a lower win rate, they're looking for a higher reward to risk ratio. What I mean by that is you can have an 80% win rate if you go for 1R. And if you go for 2R, that might drop down to a 65% win rate or a 60% win rate. If you go for a 3R, you might go down to a 40% win rate, those sorts of things, right? Okay, cool. Great. Thanks for your comments, guys. Thank you. Excellent, excellent, excellent. Okay. So now what I want to do is show you what happens next, right? So this is the kicker. What happens next here is the market goes through that first target. It goes a little bit higher. It actually wicks down quite a bit, as you can see here. But even with a break-even stop, it wouldn't have hit it there. And it goes all the way up to this next yellow box right here. In fact, if you look at it from the target, it went about approximately 120 pips from the first target to this next level, which is clearly indicated on the chart by this zone right here. Okay, you can see that the market, the market found support here, resistance there, and then it found more resistance there and hit what could have been potentially another target. It could have been your original target if you're a really aggressive trader and you don't mind a lower win rate, or it could have been a second target or whatever. The point is, it was clearly a potential target, and the market went there. And it didn't go there. It wasn't very long after the first candle that it actually went up there. So everyone see that? Makes sense? Okay. So if you look here, where this went was actually an additional 120 pips that you, quote, lost. Why did you lose it? Because you only went for 50 pips and you didn't go for the additional 20 pips. So now 120 pips, okay? So you could have made 170 pips on this trade instead of 50. Now, what I want you to do right now, knowing what we know about this hypothetical trade, granted it's not a real trade, but it's a hypothetical trade, and we're going through this motion, we're going through this whole rigmarole because we want you to get something. So what I would like you to do right now is write down what your thoughts are, knowing that you took this trade. Just envision yourself taking this trade. You took the trade, you made the 50 pips, and then bam, the market went another 120 pips. What are you thinking now? You can type it in the chat box, or you can write it down on your scrap of paper, on your chamois, the back of the book, scribble it on your beer bottle, whatever. Whatever you have. I know it's morning over in Europe, but it is the evening time over here in Asia. So what are your thoughts? Like how does that make you feel knowing that you quote lost 120 pips on this trade? Should have took half off and let the other half run. Yeah, that's exactly what I do, Frank. Or sorry, Fred. Sorry. Typically, I have 2 or 3 profit targets for this very reason. I would have taken half the trade off at the first target and then let the rest run. Whatever happens, happens. Yep, there you go. So there's another one. Abdul says same thing, essentially. So, these are the sorts of thoughts that run through your head. I feel like I should have allowed myself an opportunity to make more there, right? That's fine. That's great. Now, I'm going to give you a few more moments to write down what your thoughts are based on what you know about what happened here. Based on what you know about what happened here, write down your thoughts, okay? Cool. All right, so now let's move on, and I want to go to a different spot on the chart here. Would be happy to make the first target. I will have more opportunities in the future, says George. Thank you, George, for being honest. That's awesome. And you know what? What you just did is you're helping yourself out quite a bit here by really thinking about this, and I'll show you why in a moment. Show everyone why in a moment, actually. So let's keep going here. And you know what, George? Some people are going to be like you. Some people are going to be like Abdul and Fred and others who said that They wish they would have allowed themselves an opportunity to get that additional target, but some people are going to be okay with this. Okay, now what I want to do is show you another potential trade here. Um, okay. Hold on. Okay, here's another one. Okay, here's another one here. Now, okay, so remember what happened over here. On this trade over here, actually, we'll flag it with an arrow. This trade over here, this kangaroo tail, you had a 50 pip target, you made your 50 pips, and then the market went boom, another 120 pips. Now we have another one here, right here. And it's the same sort of deal. It's a kangaroo tail. It's a bearish one in this case, and the market goes lower. And then, let's remember here, what is a risk? The market triggers lower, and we're going for a target down here. Okay, we're going for the support and resistance, the support level down here. Okay, that's what we're going for. Because we see that the market double bottom down here, and we're thinking, yeah, we want to wait for that, right? And guess what? The market comes back after going lower and stops us out. Okay, so remember the stop loss was right here on the other side of the kangaroo tail. So we had about a 35 pip stop. The market went 125 pips, basically the same. It went about 120 pips in our favor, but then it came back out and stopped us out. Now, some of you might be thinking, well, actually write down, what are you thinking right now? Assuming that you took this trade right here, this sell trade on this kangaroo tail, write down your thoughts. Write them down on your scrap of paper. Write them down in the chat box. If you're watching this recording, write them down on your sheet of paper. Just take time right now to write down what your thoughts are. This is very important for setting what we're going to set for you, what we're going to create for you. It's critical. So I'm just going to give you a few moments to gather your thoughts and write them down, please. Fred, staying in a trade is one of my big problems. Abdul, I'd take half off at break even and ride the storm. I would have moved my stop to break even. Yeah, I know. This is kind of what I was getting at, Fred, when I said that. I know a lot of people would say, look, if you're up 120 pips on 30 pips of risk, or 35, that's almost 4 to 1, right? So your stop loss is no longer on the other side of that kangaroo tail. It's gone a long ways in your favor. So you move that stop to break even, so your stop would roughly be right there, right? Which means when it came back up here with these candles, it would have stopped you out at break even, right? So a lot of people be thinking that. I would have moved my stop to break even, yeah. A lot of people are thinking that. Okay, cool, gotcha. But now here's the question, okay? Here's kind of what I'm getting at here. In this second scenario, you still lost 120 pips, okay? You had 120 pips, but because the market didn't go far enough to your target, you didn't make anything, or you lost, depending on whether you moved your stop to break even. You moved your stop to break even, you had 120 pips and you lost them. If you did move your stop to break even, you had 120 pips and you lost 1R, right? Because it blasted through your stop loss over here. Now, in this other scenario, you had 50 pips, you got out of the trade, but then the market went an additional 120 pips. In both cases, you lost 120 pips. The loss that you had was essentially the same, but in one case, you walk away with nothing. It's like a trade never happened because you had your stop loss at break even. And in the other case, you actually made a profit, but you just missed out on the opportunity afterwards. So my question to you, and this is what this is all about, my question to you right now is this. Of these two scenarios, which one hurts you more? Is it having a profitable trade end up going much, much further after you get out of the trade? So scenario one and scenario two. Scenario one is you have a profitable trade that turns into a profit, hits your target, and then it just blasts through your target and keeps going even further. And you feel like you missed out. That's scenario one. Scenario two is you have a lot of pips in the bag, but then you give them all back and you make nothing. You don't necessarily even have a loss in this case because let's say that we're doing what a lot of people suggest here, which is you would have moved to break even if the market would have gone that far in your favor. So you don't necessarily even lose anything here, but you had 120 plus pips and you walked away with zero. So in both cases, you walked away with zero of those additional 120 pips you could have had. In the first case, you hit target. You hit your target, you're out of the trade, you're done and dusted, you walk away, and then the market keeps going without you. In the second situation, the market goes in your favor, goes and goes and goes, and then it turns around and pops you out at break even. Which of these is more difficult for you to deal with? Is it scenario one or is it scenario two? Just write those down. Write that idea on your piece of paper or in the chat box if you're here live. If you're watching the recording, just write down on your piece of paper, scenario one is more difficult for me to deal with, or write down scenario two is more difficult for me to deal with. So we're getting some votes coming through here. Scenario two, says Dia. Abdul says scenario two. Second case is more painful. George is saying the second hurts more, and additional reason that technical analysis didn't really help, support didn't reach. Fred says two. Yeah, so most people are saying scenario two. So some are going to say scenario one is more difficult, and some are going to say scenario two. All right. If scenario two is more difficult, so here's the take-home message, okay? If you've had time to do this, and I strongly suggest that you do before I launch into the next sentence so that you know where you stand. We don't want to use hindsight bias here. We want you to work off of what your thoughts are, okay? Because you're the only one that matters here when it comes to building your trading system. If scenario two is more difficult for you to deal with, where the market goes 120 pips in your favor and then comes back out and stops you out at break even, if that's more difficult for you to deal with, then you should be trading with some sort of system that allows you to trade for hard profit targets. What I mean is, if the market goes here, I take profit. That's what you should be trading with. Hard targets. If you can't allow yourself to give back when the market goes strongly in your favor, and you just can't allow yourself to give back that much, then hard targets are going to make sense to you. You should be trading with hard targets. Now, scenario one, if you are, going through this and you're saying scenario one is much more difficult, I hate it when the market gives me an opportunity to make a lot of profit and I take only a little nibble of that, right? Then you should be trading with a trailing exit. Some sort of trailing exit. If this is a painful scenario for you, you need to work with some sort of trailing exit. It could be a target plus a trailing exit. It could be multiple targets. It could be, you're trailing the exit and moving it depending on what the market does. Technically, it doesn't matter. And there are lots of these in the Naked Forex book, obviously. You'll see these, Fred, when you get the book. But The idea here is if this hurts more, you're a trailing exit trader. You've got to incorporate that somehow because that's going to allow you to trade long term the same way. And if this one is more difficult for you, you've got to use some sort of hard targets. Okay? Doesn't matter if it's support and resistance or a percentage of risk like R based or whatever. Um, you've got to learn to get your profit and run basically. Okay? Does that make sense to everyone? Does everyone understand what I'm talking about here? So if this first scenario hurts more, you use a trailing exit. If this second scenario hurts more, you need to use some sort of hard targets. Yep. Cool. You got it? Cool. Excellent. Absolutely. Yes, but how do we define hard targets? Yes, George. Multiple different ways. I can give you lots of resources or whatever, but here's a couple of ideas, okay? One can be risk-based. So if you're risking, let's say on the trade you take on Tuesday, you're risking 60 pips, so you want to go 2R, right? So you go 120 pips. That's your target. On Wednesday, you take an 80 pip risk trade, so you go 160 because you're going 2R. So you don't care about support and resistance. You don't care about what the chart says. You simply go with a hard target because you're going to be a 2R trader. If you're using support and resistance and the first support level is too close, then you have to go for the second one and so forth. You can also use what we call a ladder exit. That's also in the book, George, you'll get it. But basically what you do is you wait for the market to go, and then when it hits the first support and resistance level, you move your stop to break even. When it hits the second support and resistance level, you move your stop down to the first level of support and resistance. When it hits the third level of support and resistance, you move your stop to the second level and so forth. So you ratchet it up or ratchet it down as the market goes. You can do that too. That's a sort of a trailing exit in a way, but it allows you to lock in profit and let it go a little bit further if it wants to. But hard targets, most of the time, traders use hard targets in 3 different ways. They get a counter signal, so a signal in the opposite direction. So if you took a buy trade, when a sell signal comes up, you get out. You can use support and resistance and wait for the market to hit one of those key levels, and then you get out. You can wait for it to go a certain number of R. So if you're going to have 2-to-1 reward risk ratio or 3-to-1 or 2.5-to-1 or whatever it is, you wait for it to go there. So maybe, or maybe you have the same stop. Maybe you always use a 50 pip stop, so you always go for a 150 pip target. You could do that as well. There's multiple different ways of doing this. The important thing, I guess, to keep in mind here is that if this is what you're doing, like if this is your thing, that it's got to make sense to you. If support and resistance doesn't make sense to you, then scrap it, right? Use something else. Use R, or use a counter signal, or use something. Use a hard target that's gonna. Some people will have, like my podcast partner on the Two Traders podcast, Darren. He actually has a target number of pips every week, so he goes for 200 pips. That's his hard target. Some weeks he'll make 180, some weeks he'll make 220, but basically if he makes 220 pips and he does it by Wednesday, he usually will shut it down and go, okay, I've made my profit this week. I don't want to give it back on Thursday, Friday, so I'm done. That's it. I'm all done. Okay? So there are lots of different ways to do that. Cool. All right, awesome. All right, let's keep rolling, guys. I want to make sure that we get through all this. All right, great. So everyone's got the exit part. Now that's important. When you're building your system, you need to trade use an exit strategy that makes sense to you. Now you know which one is going to make more sense to you, whether it's a hard target or a trailing exit. Now let's go into something else here, okay? Let's go back here, and I want to ask you a question. All right. Okay. So here's the market right here, right? So this market right here. When you see this market, I'm just going to draw a box around it. I'm going to not make it red because that's hard to see, but make it green. Okay. So here's your box. When you see this market like this, it's kind of bouncing around. Let me ask you a question. What do you think? Just write down your thoughts on your scrap of paper here. When you see a market that's like this, fairly tight range, what are your thoughts? What do you think when you see this? So, for example, you might write down on your piece of paper, I think that market's directionless and I don't want to trade. Or you might write down, well, I'd be looking for trades at the edge of the box. Or you might be saying, well, the market's kind of sleeping right now. I'd wait for it to wake up or whatever. I mean, whatever is in your head when you see this, what's your gut reaction? What's the first thing that comes to mind when you see this? Is it an opportunity? Is it a market that's getting ready to give you an opportunity? Or is there an opportunity right now looking at this? Or is it just not, it's just not there yet. It's not happening for you. Ranging, I'm waiting for the breakout. The trade uh, as sideways market. Looks like we are in a range, but it looks like it's going to roll over the direction of the trend. It's not there yet. Once the breakout occurs, I'll get in. Yeah, okay. So great. All right, great. All right, just want you to keep that in mind, what you said. I'll give you a few more seconds to write it down if you're watching the recording. Just want to make sure that you're clear on what you think when you see this. Like, essentially, it comes down to this. You're going to see opportunity when you see this, or you're not, right? You're going to look at this and lick your chops and go, oh, yeah. Or you're going to look at this and go, nah, not for me, okay? That's critical. Okay. All right, now let's move on to another chart here. Here is a chart that's been going down, 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 down. When you see a market like this, let me ask you a question. What do you think? The market's been clearly going down for some time, and you see this market, what do you think? What kind of opportunity do you think the market is most likely to present to you now? So I'll write that down here so you can, again, I just want you to write this down or write it in the chat box if you're here live with us. What sort of opportunity does this market present? What does it present to you? What sort of opportunity does this market present? It might be that you look at this and go, there's no opportunity here. It might be something else. So just write down what you think you see. Okay? Making sense? Higher high, pull back and take it long, says Fred. It's a short, but I would rather stay out. Wait for buyers to show up for a trend change, or if the market breaks down again, short it as it pulls back. Okay, so there's a couple of, we've got diverging opinions here, which is great. I'll just give you a few more moments to write down on your piece of paper here. If you're watching the recording, just write down what you think what kind of opportunity does this market present? If any opportunity at all. If any opportunity at all. Okay? Cool. Waiting for a buyer opportunity, says Enrica. Cool. Great. Okay, great, guys. Thank you so much for you get more out of this when you do this, right? If you just sit there kind of but when you actually do this work, this is what's going to help you. Okay. Now, we've seen, yep. Okay. Now I'm going to show you a different type of market, okay? Okay. Okay, cool. Here's another one. I just want you to really just pay attention to, the green box here, okay? So I've shown you 3 different types of markets. This is the third one. When you see a market like this, what kind of opportunity does it present? Is there any opportunity at all when you see a market that looks like this? So the answer could be no. What sort of opportunity does this market present? So it could be, whatever you think when you see this. Sell at the top, buy at the bottom after sideways market is confirmed. Yeah. I'd shorted all the way to 105, says Fred. That's funny, Fred. This is back in 2014, obviously. Yeah, so whatever you think. Whatever you think. You could look at this and go, nah, not for me. You could look at it and go, yeah, I would do this, or I'd wait for this, and then I'd do this, or whatever. All right, so you guys have you should have enough time, hopefully, to written everything down. So you've seen three different types of markets. We know what kind of exit is most likely to fit with your beliefs about the market. We've already identified that. And now we're going to show you what kind of system you should use with that exit. You've seen three different markets. You've seen this one, which is basically a range-bound market, right? It's range-bound. It goes up, it comes down, it goes up, it comes down. It's been bouncing off the edge of this box over and over again, and then finally it breaks out of the box right here. But it was in that box for quite some time, okay? So that's a range-bound market. For some of you, this is the market that makes, which is the kind of market you want to trade. You want to buy it at the bottom and then sell it at the top, and then buy it at the bottom. You like this. It's defined. It makes sense, right? So you want to do that. Okay, and for some, so which of these three was the one that you most wanted to trade? So in other words, one of these markets is sort of a, I got to take this trade setup. I got to do it. You just feel like you got to do it. It was either this one, which is a range-bound market. So you might have looked at this and said, yeah, that's the one for me. That's the one I like to trade. Okay? It might have been that one. It might have been the trending market that we had here when the market was going down, down, down. What kind of opportunity does that market present? The market was trending down. And so you might have seen an opportunity there to either go counter trend when the trend was going to turn around, or go with the trend, right? So that says a lot about what kind of trader you are. If you were looking for a buy trade here, then you are potentially that counter trends type trader that looks for the end of the trend, because at the end of the trend, what happens? The market goes really quickly in the other direction. It slowly goes in the direction of the trend. It sort of plods its way in that direction. But when it's counter trend, it collapses all at once and usually shoots up rather quickly. As you can see here, here's kind of the end, and it went shot up here and it shot up there. That's pretty typical of the end of the trend. And then there was that other one that was a really tight range, right? It wasn't really range bound. It was more of just a quiet, tight market. And some traders see this and they think, yeah, I want to trade this. I want to trade the breakout. Okay? Traders see this and they want to trade the breakout. You're a breakout trader. So if this first scenario was the one that you were most interested in, you're probably a breakout trader. If you were thinking to yourself, yeah, I like this. I like it when it gets quiet, because then I'm going to pounce on it when it breaks out of that and make a whole bunch of money. Look at that. It was tight for a long time here. And what did it do? It fell, consolidated again, and fell like a lead balloon, didn't it? Right? So if you like the first one, you're a breakout trader. You should look to trade a breakout system. If you like the second one to go against the trend, you're a counter trend trader, because you want to go against those trends. Or maybe you were a trend trader. You saw that and you said, I wanted to go with the trend, wait for a pullback or whatever, but you want to go with that direction, which is down. And then finally, that third one was a range-bound market. If you like trading range-bound markets, then you like those defined boxes, the areas where you can short all the way down to the bottom and then buy all the way back up to the top and so forth. Does this make sense to everyone? Does everyone understand now? Because now you know. You like to trade range-bound markets, you like to trade counter-trend, you like to trade with the trend, or you like to trade breakouts. And in essence, all trading systems fit into one of those categories, okay? All of them. Doesn't really matter what anyone says. I don't care if you're scalping or whatever, it fits in that, it fits into that category. Does that make sense? So you should know now a couple of things about yourself. And this is really critical because a lot of people they don't go through this. What they do is they go, oh, Joe Blow's making, 1,500 euros every 3 hours trading every night. I'm going to go do what Joe Blow does, and I'm going to, go buy a Ferrari next weekend. But that's not how it works, right? Because Joe Blow might be doing really well with his trading system because he's trading his beliefs. As soon as you trade Joe Blow's system, you're going to do one of two things. You're going to run into a drawdown and you're going to quit and say it doesn't work anymore, or the market's changed, or some other silly reason to stop trading it, or you're going to modify it And why are you going to modify it? Because it doesn't fit your beliefs. You're going to change that system. And I actually think that's a really good thing. It's better than saying the market's changed and, the system's broken or whatever. But my whole point and the whole reason of going through this whole process with you today is because I think you should do this first. You should define your beliefs first and then build a system around that. Most people don't do that. They look for a system that they think is perfect or close to perfect or makes a lot of money or so and so, it works for them. So I'm going to do that. I'm going to just copy what so and so does. Well, that doesn't work. That won't work unless you're lucky enough to copy someone's system that fits your beliefs. And that's usually not the case. Does that make sense? So now you should know right now whether you are a counter trend trader, a trend trader, a range trader, like basically trading off the edges of the range, or a breakout trader. Does that make sense? You should also know whether you should go for hard targets or whether you should use some sort of trailing exit. Does that make sense? Does everyone see how this fits in? Awesome. Cool. Awesome. Great. Great, great, great. Sounds good. All right. So that's basically what I wanted to show you is that you can build a system based on your beliefs. You've decided which of these three types of markets you would like to trade, and you've also decided which kind of pain you want to avoid with your exits when you get out of the trade. So now you know what kind of system you should be trading. You know what kind of exit you should be using and what kind of market you should be trading, whether it's range bound, trending, or quiet sort of consolidating really tight market that's getting ready to break out. So now if there are any questions about the live markets, I'm happy to take those now. I'm in a couple of trades. I'm in the Canadian dollar weekly chart trade here off this bullish big shadow down here. It had a pullback. It's gone up a little bit. It's down a little bit this week. There's my entry. There's my stop. And I'm also in a trade on silver, which is over here. It hit target one. I held both of those trades through Brexit, the silver weekly chart trade and the Canadian dollar weekly chart trade. I've held both of those. So those are the trades that I'm in. If you guys have any, what was your buy setup on the CAD? It was a bullish big shadow on the weekly chart. That was a bullish big shadow. That's what that was. And then there was a kangaroo tail a few weeks ago on the silver chart. And I'll show you that in a moment. 1 second. Silver is right here. And so, wait a minute. Hey, I think no, we still haven't hit my target. Hold on. No, we're going to hit my second target. Cool. Awesome. So, and I got a third target up here. So you can see, this is what I was talking about earlier, Fred. I usually use 3 targets. So this trade, and I moved this to plus 10 cents. So the stop loss was down here below the kangaroo tail, right? And then I moved it to plus 10 cents, in anticipation of Brexit. Also, it had already hit my first target here on this candle at 1780. So I'm waiting now for it to hit my second target, which is awesome. And then we'll see if we can get up to 2150, which is my third target. So that's my other one. So this was sort of a kangaroo tail. So it kind of broke through this level here, pulled back, gave me a sweet kangaroo tail, got into it. I knew that it could have double topped up here, which is why I had target 1 there. I had a really strong zone up here at 1850, which is fast approaching. And hasn't quite hit my target yet, but hopefully it'll happen today. And then 2150 is kind of later on, maybe like in a couple weeks or something. So those are, not sure what a bullish big shadow is. Do you use a trend line? You can use a trend line. I don't necessarily. I like my horizontal support and resistance levels. But a bullish big shadow, if we have time, I think we do have time. It's in the book. I think it's chapter 8, but we have just a moment here, Fred, and I will show you why that Canadian dollar weekly chart trade was a setup for me. Hold on, my chart just has to load. I know it's kind of painful. Okay, so here it is. All right, so what happened here is this bullish candle here, it's the biggest candle in terms of the range from the low to the high. It's the biggest one we've seen in the last 5 candles. So it's bigger than this one, that one, that one, that one, and that one. The close is up near the high. and it completely engulfs the prior candle. See how it's got a lower low than the prior candle and a higher high, and it closes up near the high? Um, the trend line is not really that important here. What's important is the candle. Uh, and also remember there was kind of a resistance level over here where the market couldn't get through for a long time and finally did, but so that was going to be support over here. And so when the market cleared the high here on my bullish big shadow, which is a special case of an engulfing candle, basically, then I was in, and then I went up, and then it pulled back, and then it went up a little bit this week. It's pulled back a bit. So I'm still holding out for 33.30, 38.20, and 46. So that's that one. That makes sense, Fred? It's all in the book. I know I kind of blew through it because we're at the end of the session here, but I just wanted to make sure that that you got that. Yeah, it's all in the book. Tons of examples on the big shadow. It's just a special case of engulfing. That's all it really is. Okay? Sweet. I hope you get the book today too, Fred. That's awesome. Okay, cool. Awesome. Thanks, guys. Thank you so much for your time. I really appreciate it. I hope that you have a wonderful trading week. If you have any questions or anything, you can let me know, right? So no problems. Just hit me up. Here's my email. I'm happy to help. I'll send you a book, like whatever you need. Send me. I have like ebooks and stuff. Whatever you need, just send me an email and I'll get you set up. Okay? Cool. Thanks so much, guys. Hope you have a wonderful week. Happy trading. Take care. We'll see you soon. Okay? Thanks again for your time, and thanks to all of you watching the recording. Thanks, guys. Bye.